Hey YouTube, I'm back here again because I wanted to show this article about the Fed approving the rules loosening Dodd-Frank bank restrictions. But before I get into the article, which I got from the apnews.com, I wanted to go back to the history of the Dodd-Frank Act and why it was created. So let me start there. So this is a picture of Congress and President Barack Obama signing into law the Dodd-Frank Act. And we're going to read a little bit in the article and we're going to see exactly what's going on by this history of this Dodd-Frank Act. And we're going to see that something is happening that really and truly shouldn't be happening. And it's going to prove that the Fed is actually above even Congress. So the Dodd-Frank Act, officially called the Dodd-Frank Wall Street Reform and Consumer Protection Act, is legislation signed into law by President Barack Obama in 2010 in response to the financial crisis that became known as the Great Depression. Dodd-Frank put regulations on the financial industry and created programs to stop mortgage companies and lenders from taking advantage of consumers. The dense complex law continues to be a hot topic in American politics. Supporters say it places much needed restrictions on Wall Street, but critics charge Dodd-Frank burdens investors with too many rules that slow economic growth. Now, if you go back to the financial crisis, you're going to know that there was a lot of predatory lending. There were a lot of people who received loans for houses that should not actually receive these loans, and it caused a lot of people to lose their home and became homeless. It says the Great Recession, a crisis that left millions of Americans unemployed and sparked worldwide economic decline, began in 2007 of December and lasted well into 2009. In September 2008, financial instability peaked when the fourth largest investment bank in the United States, Lehman Brothers, collapsed. Now, if you know, it was also Fannie Mae and Freddie Mac. They all went down too. Many of the companies went down, including AIG, and if it wasn't for a government bailout, these companies were supposed to be insolvent, but billions of dollars were pumped into them. It says stocks plummeted and the market froze. Fear and instability paralyzed the country as large companies and small businesses alike struggled to continue operating. In addition, many investors were extending their funds and exhausting their financial reserves. The federal government stepped in quickly, proposing legislation for financial reforms. Now it says that the oranges of Dodd-Frank, it came from basically, the name actually came from Senator Chris Dodd and Barney Frank, who introduced new revisions to the bill in December 2009, and that's where it got the name from. It says this bill included the government's most substantial changes in response to the economy since the Great Depression. Now, if you know what the Great Depression was, that was in 1929. So there was a panic before the actual Great Depression, if you go back and you read history. I'm not going to touch on that right now. It says, in fact, it's considered the most comprehensive financial reform since the Glass-Steagall Act, which was also removed, which was there to protect us from these banks. And since that was removed, it caused the banks, it actually created a crisis of 2007, 2008. It says, in fact, it's considered the most comprehensive financial reform since the Glass-Steagall Act, which was put in place after the 1929 stock market crash. Right? So, what is Dodd-Frank? It says the Dodd-Frank Act is a comprehensive and complex bill that contains hundreds of pages and includes 16 major areas of reform. Simply put, the law places strict regulation on lenders and banks in an effort to protect consumers and prevent another all-out economic recession. Now, just remember this one here: to prevent an all-out economic recession. We know that economic recession is a big talk for the past few months, but we'll get into that a little bit. Dodd-Frank also created several new agencies to oversee the regulatory process and implement certain changes. Some of the main provisions found in the Dodd-Frank Act include banks are required to come up with plans for quick shutdown if they approach bankruptcy or run out of money. Financial institutions must increase the amount of money they hold in reserve to account for potential future slumps. Every bank with more than 50 billion of assets must take an annual stress test given by the Federal Reserve, which can help determine if the institution could survive a financial crisis. The Financial Stability Oversight Council identifies risks that affect the financial industry and keep large banks in check. The Consumer Financial Protection Bureau, or the CFPB, protects consumers from the corrupt business practices of banks. This agency works with bank regulators to stop risky lending and other practices that could hurt American consumers. It also oversees credit and debit agencies as well as certain payday and consumer loans. So I'm going to stop right there because we could already see basically that it was a contingency plan, or so they call it, to protect the consumers from the predatory banks that had stolen a whole bunch of people's lives in the last great so-called recession. I call it the Great Depression. If it wasn't for the great print, there would be bread lines all over America. So I wanted to basically touch on that. But there's also a little part on the Volcker Rule I wanted to touch. It said that an additional provision to the Dodd-Frank Act is known as the Volcker Rule, named after Paul Volcker. Everybody know he was a Fed chairman who raised the interest rate back in the late 70s, early 80s. And they say that he was the one who basically, caused the markets to regain stability back in those times. It says Volcker was chairman of the Federal Reserve under President Jimmy Carter and Ronald Reagan, and chairman of the Economic Recovery Advisory Board under President Obama. The Volcker Rule forbids banks from making certain investments with their own accounts. Now, with their own accounts or with our accounts. For example, banks can't invest, own or sponsor any proprietary trading operation or hedge funds for its own profit, with some exceptions. Now, if you think about this for a moment, right? There are many hedge funds out there that is actually used right now to support the markets. And nobody knows who these hedge funds are. But there's always these algo trading that is actually causing the market to go up based on keywords. And I use the word up because the market hasn't had a really decent sell-off in a while. Because every time either the Fed comes out and speak, or one of the Fed members, or the president, or some keyword comes out, the market shoots up, goes 2, 3, 400 points, and especially at a point in time when the technicals say that it's supposed to drop. Now, let's touch on this article about the Fed, who approved the rules loosening Dodd-Frank bank restrictions. The first major question anyone should ask themselves is this: how did the Fed get the authority to loosen the Dodd-Frank bank restrictions when this is supposed to be an act of the president or Congress? How did the Fed get the right to go ahead and give the banks the okay to do or don't do anything when this law wasn't even put into place by them, according to what we just read there? So let's read the article anyway. The Federal Reserve is easing restriction imposed on banks following the 2008 financial crisis, giving a victory to the banking industry and President Donald Trump. But wait a minute. It never said that Donald Trump was the one who eased the restrictions. But yet still it's saying that the easing of these restrictions is giving a victory to the banking industry and Donald Trump. Anyway, say the Fed on Thursday approved a set of rules changing that implement changes that implement legislation passed by Congress last year to loosen restrictions, particularly for smaller community banks imposed by the Dodd-Frank Act passed in 2010. Trump has often criticized Dodd-Frank, which he says has hurt economic growth by making it harder for banks to lend. Now, the truth be told, banks are no longer lending an institution. Whoever puts their money into the bank becomes the lender. You're not lending to anyone but the bank. Banks are not lending institutions. They're gambling casinos. All they do is they take your money, my money, whoever's money, and they go out there and they gamble in the stock market. That's who's behind all the hedge funds. He said the Fed changes will ease requirements of banks for holding capital and cash, and also for the so-called living wills big banks must develop in case they fail. Now you remember that living will was the banks were supposed to shut down if they fail. But now that the Fed has become the lender of last resort, banks no longer have to shut down now. Because the Fed couldn't go ahead pumping that methadone inside of there and keep those banks basically solvent. When they bring the interest rate to zero, the banks get to borrow money for nothing. It says the Fed approved the capital liquidity changes and the modification on living wills by 4-1 votes, with Fed board members Lael Brainard, the one with the brains, casting the lone no vote. So the one with the brain cast the no vote, but he was overruled by the 4 members who didn't have brains. Well, sorry, she was overruled by the 4 members that didn't have brains. She said she believes the changes will weaken critical safeguards governing the largest institution. And she's right. So the one with the brain, the Brainard, was rejected by the 4 non-brainards. The rule changes kept a multi-year effort by the banking industry to loosen restrictions imposed by the 2010 law. The law was backed by the Obama administration with the aim of preventing a replay of the 2008 financial crisis, the worst banking crisis since the Great Recession of the 1930s. And I'm here to let you all know that every 10 years or so, there's a banking crisis. The fact that the Fed has loosened these restrictions on these banks and given them the green light is letting you know that we're closer to the crisis than farther away from it. Because there's a movie that's called The Crash. And in that movie, the Fed chief met with the bankers in a circus. And he said that this is how the Wall Street, the stock market was created. And in that movie, the Fed chief met with the big banks, and the Fed was getting ready to crash the market using a virus, and he had it on a little jump drive. And they were going to use hackers to hack into the market and crash it. Now, the whole goal of it was the stocks was going to tank. And once the bank stocks tanked, the banks would be able to take and buy back their shares and the whole stock market for pennies on the dollar. So the very same thing that caused the market crash in 2008 is getting ready to repeat again. And that movie showed it. And they removed that movie from on the internet. You either have to buy the DVD, or if you go on YouTube, you might be able to find it. I had it. I watched it on YouTube. I went ahead and got the degree. I'm sorry, the DVD. Sorry, the degree. Really? Anyway, Greg Gelzinis, a policy analyst with the Center for American Progress, said the rules changes are a mistake that puts the financial system at risk. He's not telling no lie. But the truth is I know that they need a crisis in order for them to gain control of everything. Because once people's money is held hostage and there's nothing they could do, they're going to beg for a solution. Reducing the stringency of bank capital requirements, liquidity rules, and stress testing makes large bank failures more likely, while watering down living wills requirements magnifies the economic devastation caused by such failures, he said. The living wills requirement was enacted by the 2010 law to make sure financial institutions have plans for winding down their operation in the event of a failure, so that taxpayers are not left liable as they were in the 2008 crisis. Well, you ain't got to worry about the taxpayers bailing them out. There's a bail-in clause now where the banks could basically just take your money because you're now a creditor to the bank. The rule changes modify the frequency the living wills will have to be updated. Rob Nichols, president of American Bankers Association, praised the Fed for the changes, saying they will fulfill the 2018 law aimed at tailoring government regulations to better match each bank's business model. In addition to the Federal Reserve, parts of the regulation will also need approval from the Federal Deposit Insurance Corp, which is the FDIC, and the Office of the Comptroller. The rules will go into effect after publication in the Federal Register. So again, here you have the Federal Reserve doing political things, as in creating rules now to give the banks the okay or the not okay as what they should and should not do. Back in June, the Fed also gave the banks the opportunity to buy back their own shares. So if anyone could tell me that the Federal Reserve is not a criminal entity, then you'll have to prove me wrong somehow, because there's no way that the Fed is supposed to be giving banks the authority, right? Or actually to be easing restrictions for the bank when there's a law that was put into place by Congress. This is to show you that Alan Greenspan wasn't wrong when he said the Fed is an independent agency. They don't answer to anyone. This is just information I wanted to share. I hope that this video is education for each and every one of you. And this is a little nugget that I found that I haven't seen anyone reporting on. Please share this video. Give me a like. If you haven't subscribed, subscribe. And if you'd like to support my channel, I'll leave the links for these articles below. Y'all have a good night. And thank you again.